In this video, we will ask the question, is the United States in another housing bubble? And we will look at this in the context of the multiple economic crises that have happened over the last century. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently working part-time as an adjunct professor of accounting and financial management for the University of Maryland's Global Campus, and also as a portfolio analyst and retirement strategist. This graph shows U.S. home price growth from 2001 to 2021, so basically just in recent time periods, and we can see that price growth of 5 to 10% annually, even up to 15%, was not uncommon. The 15% would have occurred right before the housing bust, in which case at the peak of drops we had close to 15% in drops, largely between 2007 and 2009, but basically negative housing prices occurred all the way up to around 2012 or 13 when you saw a large recovery in housing prices. The increase in housing prices during the COVID era of around 20% is the largest on at least record during the time period of this graph, which would be an indication of another bubble forming in housing. This graph shows nominal house prices using the Case-Shiller and CoreLogic indices as a function of time from January of 76 into January of 22. You can see we have the general increase in housing prices with a moderation in the increase or stagnation during recessions, and some drops during recessions, a very mild drop in 1990, and then a huge drop during the bursting of the housing bubble. We can also see that generally the price increase was reasonably moderate until the housing bubble time period and until in recent years. We expect over time house prices to go up as everything goes up with inflation, and also houses are generally larger today than they were in the past. So the question we're going to ask is, this increase that we have seen recently during the COVID era in particular, it has skyrocketed, likely to result in a huge drop like we had during the burst of the housing bubble. A good way of measuring this, which will not just be in nominal terms, since again prices go up with inflation, but would be in the home price divided by the median income ratio, which is an indication of the average American's ability to purchase a home. We can see by this measurement, as Americans became more wealthy and houses were built, particularly post-World War II in the 50s, in large numbers, the number of Americans able to easily afford a home increased from the 50s to the 70s, pretty much stagnated from 70 to 2000, and then it became more difficult for Americans to purchase houses post-2000, and this peaked during the housing bubble of 2007. Then as the recession came out of that and the stock market dropped and the housing market dropped, we had a huge drop in housing prices, and housing affordability returned to around where it was in 1960, but never down to the 70s, 80s, or 90s. Since then, we have seen housing prices increase, and during the COVID era, this massive spike in housing prices, making them even less affordable than they were during the peak of the housing bubble. By other measurements, on the other hand, housing prices don't really look too bad. This is a ratio of the S&P 500 index over the Case-Shiller Home Price Index. We can see that stocks went up a lot more than housing in 1929 with the stock market bubble. Stocks also went up gradually from the 50s to around 70 more than housing, and stocks went up way more during the dot-com bubble than housing. If we look at 2007, then housing looked pretty expensive, at least compared to recent stock market performance. Currently, the S&P 500 is very expensive versus housing, so a bubble in stocks seems a lot more likely than a bubble in housing. This is one indication that rather than worrying about a housing bubble, we are more inclined to worry about a stock market bubble. If we look at the Shiller Case Home Index over a gold ratio, we also find that real estate does not look terribly expensive. After Nixon defaulted on the gold standard in the 70s, the price of gold skyrocketed, and as a result, during the 80s, around this time period, real estate was cheap relative to gold. Similar today, even though gold prices have not gone up that much, the price of real estate is relatively cheap in gold terms. Another reason not to be terribly worried about housing prices is housing supply and demand. If we look here at housing prices and their change on the left axis in percent and housing supply on the right axis, measured in number of months of supply, that would be the number of houses on the market divided by the time period it takes to sell them, we find that in effect there is not in any means a housing glut. Prices have skyrocketed, but supply is quite low, in fact about the lowest on record. Whereas during the housing bubble, the supply of houses was extremely high, and it started going up basically when that bubble burst. Currently, there is really no increase in housing supply. One of the reasons that housing prices have skyrocketed is the price of the input materials in purchasing them. This is the lumber price in US dollars per 1,000 board feet. Due to supply chain problems, people not working, etc. during COVID, the price of lumber went from $250 per thousand board feet all the way up to $1,500 for an increase in a factor of 6. At this time period, it is still up by a factor of 4. This drastically increases the price of housing construction, and therefore this is going to be a supply issue and not necessarily a bubble issue. And of course, other products have gone up in similar prices. Labor is hard to get to build houses. My brother's office was burned down. He is attempting to get vinyl siding to repair it. That is also hard to get a hold of. Another thing that has increased housing prices is increases in the cost of regulation. My hometown, the city of Kirksville, Missouri, recently in 2016 adopted lots of international codes. The International Building Code, the International Plumbing Code, the International Residential Code, the International Mechanical Code, Fire Code, Fuel Gas Code, Property Maintenance Code, and Energy Conservation Code. These codes have also made it far more expensive and difficult to build or even repair property. Our office was vandalized and a tenant that moved out did a lot of damage to it. We have been attempting to repair that and have found that we are supposed to pay thousands of dollars to architects for approvals through the city for relatively minor repairs like moving around electrical sockets and removing non-load-bearing drywall that in fact was not coded to put in. So these sort of regulations, when applied to housing, also drastically increase costs and reduce supply. The National Association of Home Builders, which represents the largest network of craftsmen, innovators, and problem solvers dedicated to building and enriching communities, believe that regulation imposed by all levels of government now account for around $94,000, or 24% of the average sale price of a house of close to $400,000. Of that $94,000 figure, $41,000 is attributable to regulation during development, and around $53,000 is due to regulation during construction. These kind of regulations make it far more difficult for the average American to buy a single-family home. Also, the National Association of Home Builders has developed this nice graph on government regulations as a share of multifamily development costs. So this would influence your rental price if you wanted to rent an apartment. And for the average apartment, they believe the cost increases from changes in building codes just during the last 10 years have increased this cost by 7%. They believe the overall cost of government regulation as a share of multifamily development cost is 32%, or about of the third of the rent check you would pay. 5.9% is development requirements beyond what the developer would ordinarily do. 3.9% are fees charged when building construction is authorized. 4% is cost of applying for zoning approval. 4.2% is non-refundable fees charged when site work begins. 2.3% is the cost of complying with OSHA requirements, and that leaves another 4.8% just in general regulation costs. We will now look at the potential housing bubble in the context of a longer history of economic crises. Well, there was around a 30% pullback in the stock market at the beginning of the COVID era. The Federal Reserve printed tons of money and supported the stock market, and it massively recovered and, in fact, skyrocketed after that time period. So that probably would not fall into the economic crises category. The economic crises that we will look at are the one most resembling, if it were to occur, a housing bubble, which would be the housing crisis of 2007, 2008, you could say on to 2010. We will also, to some extent, examine the dot-com bubble of 2000 to 2003. Another banking crisis related to housing would be the savings and loan fiasco of the 1980s and 90s. There were crises before that, the U.S. default on the Bretton Woods Agreement and on the gold standard in 71, the U.S. default on the gold standard in 33, of course, the Great Depression and the stock market crash of 29 and the panic of 1907. Those type of crises are explored in some of my other videos, but will be not examined in this one in detail. When we have economic crises, sometimes they result in bank failures, sometimes they do not. The stock market crash from 29 to 33 resulted in tons of bank failures. At that time, many of the banks invested not only in debt, but also in stocks. They commonly allowed 90% leverage, so a 10% drop in the stock market could cause margin calls and then cause eventually a lot of the banks to go bankrupt. That was a bank failure related to the stock market crash. These two sets of bank failures are both related to our topic, which is housing. So this is the savings and loan fiasco in the 80s, and that is related to problems in the housing market, in particular the mortgage market. And also we have the housing crisis here, 2007 to 2009, 10, etc. The banks tended to go bankrupt, of course, after the housing prices had dropped. So both of these are housing-related bank failures. The first of the economic crises we will look at that resulted in a large number of bank failures is the savings and loan fiasco. During the savings and loan fiasco, not very many people lost their homes or had their homes taken by banks due to loan defaults, but a large number of banks, and particularly savings and loans, went bankrupt. This was caused by a phenomenon called duration mismatch. If we look at this graph from around 1960 to 2000, we see that during this time period, inflation skyrocketed from around 1% in 1960 to over 12% in 1980. Long-term interest rates also went up, going from around 4% in 1960 to 16% in the early 1980s. How does a bank or savings and loan make money? They make money off of a normal or upward sloping yield curve. They borrow through checking accounts or savings accounts at the short end and lend at the long end. In particular, savings and loans would make their money by savings deposits, short-term deposits that the depositor could take out at any time period, and then taking that money and making 30-year fixed-rate home loans. They were legally very restricted in what they were allowed to do. So a savings and loan in 1960 might make a home loan at 4%, and that would be a 30-year loan, and that would go all the way up here till 1990, and they would finance that with deposits in their bank that were paying interest. During the 1960s, we can see inflation went up quite a bit. This was caused by the U.S. printing money to finance Lyndon Baines Johnson's Great Society programs, Medicare, Medicaid, and housing, and also to finance the Vietnam War. This resulted by the early 1970s in the U.S. not being able to honor its agreements under the Bretton Woods Agreement, and they defaulted on the international gold standard against the French. Inflation after this continued to skyrocket it up to around 13%. There were various government efforts to fight this. Nixon initiated price controls briefly, but they did not work, and the only one kept long-term was on oil. Ford tried to have win buttons for whip inflation now and have a campaign against inflation. Of course, that did not work. And then finally, what tamed inflation was when Paul Volcker took over the Fed, appointed by Jimmy Carter in 1979, and massively increased short-term interest rates, pushing the economy into a recession. So how did this affect the savings and loans? Well, the poor savings and loans were making these long-term loans at around 4%, and those were again 30-year fixed-rate home loans, but their cost of borrowing went up with inflation and the short-term rates. So by around 1980, they were borrowing at 12, 14. Even I had a money market that paid 18% briefly. So if you're borrowing money at 18% to finance a loan at 4%, you're going to lose money, and that made the savings and loans go bankrupt. In reality, due to government regulation, it was a little bit more complex than this. There was something called Regulation Q, where the government set short-term interest rates, and this applied to the savings and loans in banks, capping them out at, I believe, 5.5% for the savings and loans and 5.25% for the banks. Money market funds started to pop up during this time period that were not subject to this, so people would remove their money from a savings and loan at 5.5% and stick it in a money market to 18%. I did this when I was a kid, making money from mowing lawns. So the interest rate increase killed the savings and loans, and the disintermediation of everybody taking money out of the savings and loans and putting it in a money market also killed them. Savings and loans did do strange things to try and keep depositors, like since they couldn't pay them interest, give them toasters and plates. But of course, this did not work. Here we see the inverted yield curve in 1980. Again, the way Paul Volcker got inflation under control is he increased short-term interest rates, making it very expensive for people to borrow. This, of course, would have crashed the housing market. Nobody could afford to buy a new home. It also had pretty drastically negative effects on the labor market. One of my friend's fathers was an unemployed bricklayer during this time period and shot himself due to depression from unemployment. And you can see, obviously, from the point of view of a bank borrowing at this high of interest rate to finance a long-term loan was not functional. The yield curve here was inverted, and this actually did work and got inflation under control. So if you were smart during this time period, even though you could have got a 15% short-term rate of return on your money, you would have been wise to invest long-term out here at 12%. One of my uncles, who was very smart and did this, Bruce Collier, was able to deposit a lot of money at 30-year rate of 12%, and for the next 30 years from 1980 to 2010, earned a 12% are basically a stock market rate of return while not taking on any stock market risk. This is an inverted yield curve, which is rare and only occurs when the Fed is fighting inflation, which they really don't do very often. A normal or upward sloping curve is what you see down here, where short-term rates are lower than long-term rates, as was the case in August of 1999, February 2000, and most time periods. And during these time periods, banks can make money because, again, they borrow short-term and lend long-term. Shown on this graph is the federal funds effective rate, which is controlled by the Federal Reserve Board. The interest rate is here on the left, and the time period from 1955 till 2002 today is on the right. You can see that this rate has changed drastically throughout this time period, violently going up and down. Those who believe in Keynesian economics believe that the federal government can use this rate to stabilize the business cycle. Those from more of the Austrian school believe that changing this rate and having government control interest rates causes malinvestment and also causes the business cycle. You can see right here the maximum interest rates of approaching 20% caused by Paul Volcker to get inflation under control in the early 1980s. That caused the recession of 1980 and the inverted yield curve. They were related as later on to the savings and loan fiasco, which we discussed. If we look at this time period here, that is the time period of the so-called housing crisis, and we can see how changing this rate could have caused the housing crisis. So at the end of the dot-com bubble around 2000, the U.S. went into a recession as the stock market crashed. The Federal Reserve had believed that the stock market was going up too much and we were in a bubble territory, and they had raised interest rates, as you can see here, around 2000. The stock market then crashed, went into a recession, and the Federal Reserve Board then lowered interest rates drastically to try to stimulate the economy out of a recession. If you lower interest rates, then people can borrow more cheaply, and they borrow and buy houses, and housing prices went up. And then the Federal Reserve Board decided to stabilize interest rates by, again, raising them, as you can see here, around 2005. Well, tons of people then borrowed money. They had used that money to buy homes, and then the Federal Reserve raised the interest rate that they would have to pay on those homes. One can see how that could cause a burst in the housing bubble. So if we look at this equation, this would be a valuation for a bond or home mortgage. This would be the value of the bond or home mortgage from the perspective of the bank, and it's a discounted sum of all future cash flows. These would all be equal for an amortized mortgage. For a bond, you have big cash flow at the end. So the value of the home mortgage or bond is the discounted sum of all these cash flows to a given interest rate. During the savings and loan fiasco, the people who had home mortgages were able to make the payments C on the home mortgage, but from the bank's point of view, the cost of capital here went up, so I went up drastically, and therefore P went down, the value of the home mortgages went down, and that is what caused the savings and loans to go bankrupt. During the housing crisis, on the other hand, I going up did not drastically affect the banks. What it drastically affected was C, and the home mortgage owners defaulted on their home mortgage payments and were not able to make them. So C went down, and that made P, the value of the home mortgages, drop, and again made banks go bankrupt. If we consider an individual borrowing $500,000 for a home loan, well, you can see when interest rates were really low, when the Federal Reserve was trying to stimulate the economy, you could buy a very, very low variable home mortgage, adjustable rate mortgage, and let's say at 1% for $500,000, we would have 500,000 times 1% interest divided by 12. So if we just look at the interest component, payment on a home loan, it would be only $416. Maybe you could add more up to that, $500, whatever, for a loan that includes both the interest only and the component that pays down the size of the mortgage and amortizing a loan. But when the Federal Reserve raised interest rates around 2005, that 1% might have gone up to 5% since these were adjustable rate mortgages, and then that same $500,000 mortgage would have over a payment of $2,000 a month, a drastic increase in payment sizes in this example. So the family that could make the payment of $400 or $500 could not make the payment of $2,000. And on top of that, of course, the value of their house would be dropping during this time period. They would be upside down on the loan. They would probably owe more on the house than it is worth, since during this time period the banks were not requiring even the traditional 20% down payment. So they had the incentive just to give up the loan, default on the payment. They were upside down anyway. They didn't have any equity, and the home loan would be defaulted. That would go back to the bank, and the banks ended up with all these houses that they couldn't sell and all these non-performing loans. The next graph we were going to look at is adjustable rate mortgages as a percent of overall mortgages as a function of year. So on our y-axis here on the left, we have mortgage rates, which have been going down from around 10% to, at the end of this graph in 17, only around 5%. Now they're even lower than that. On the right side, we have a percentage of mortgages that are adjustable rate, meaning they go up and down every year, as opposed to fixed rate like 30-year mortgages, which are fixed for the entire length of the mortgage. And on the x-axis at the bottom, we have the year from 1990 to 2017. So we can see that during that time period, interest rates dropped drastically, and the percentage of mortgages that were adjustable rate went up and down in a spike-like fashion, hitting around a third here in the early 90s, again around a third in the late 90s, and up above a third during the time period that led to the burst of the housing bubble. So during the housing bubble, lots of home mortgages were made. A lot of them were adjustable rate. A lot of them were made to people who probably shouldn't have had mortgages in the first place, and they were not required to put the traditional 20% down in equity. So as you can see with these adjustable rate mortgages, as interest rates went up, people were not able to make the payments on their home loans. Well, what about today? Well, now we're at 2022. It's beyond this graph, but pretty much you can assume this continues, and there are very few adjustable rate mortgages on the market, less than 10%. So again, if interest rates go up, you will not have the situation of the housing bubble. You will not have a lot of people whose payments on their mortgage every month doubles, triples, quadruples. So it is unlikely that we are going to get a burst of a housing bubble like we did during the 2007 time period. Here is mortgage delinquency rate as a function of year, going from 1979 to close to today, 2021, and the past due mortgages, total past due mortgages here are in blue, and it tracks a lot of the time the civilian unemployment rate, which we see in yellow. So again, the highest level of mortgage delinquencies occurred during the time period of the bursting of the housing bubble, getting up here around 10% in 2010, going down drastically after that. At the beginning of the COVID era, we had a spike up in mortgage delinquencies up to 8%, but it went back down very quickly. So again, we do not have an indication right now of there being a major problem with defaults in the housing market. Similarly, if we look at non-mortgage debt, we have credit card delinquencies 90 plus days. It's gone up during the COVID era from around 8 to 10%, but it's not a drastic problem. It's certainly nowhere near where it was during the bursting of the housing bubble. and other consumer debt, the 90-plus day delinquency rate, has barely gone up, maybe from 7 to 8%. So again, there does not appear to be a debt default problem. That does not mean that all is well in the world. We are not probably in a drastic housing bubble. We are probably in a stock market bubble. So this graph shows from 1875 to today the Shiller price to earnings ratio on the S&P 500. So this is the price you would pay for the S&P 500 divided by the 10-year average of earnings. The inverse of this, the earnings over price, is sort of like a rate of return on a bank account or an interest rate. So the higher this is, the lower your rate of return or your interest rate is. Right now we're about 40. This has only been higher during the dot-com bubble, so this is the most expensive stock market except during the dot-com bubble. It is even more expensive than the peak of the stock market that then led to, in some ways, the Great Depression when it crashed. Also similar to the dot-com bubble, certain stocks are way more overvalued than others. This is the Wilshire 5000 growth to value ratio. The Wilshire 5000 is basically the entire United States stock market. If you split it in half and look at the high price to earnings ratios, high market to book value stocks, and compare them to the low price to earnings ratios, low market to book value stocks, then that is the Wilshire growth to value stock. And it's basically a measurement of things like dot-com companies divided by the valuation of things like oil companies and banks. This ratio was way out of whack during the dot-com bubble. As you can see here, it was above 1.5. And the bursting of the dot-com bubble, the dot-com stocks crashed, the tech sector crashed. A lot of the other parts of the stock market went down a little, but not that much, and recovered basically within a year. We're in a similar situation today, where the growth stocks, the tech stocks, are way overvalued. They drastically went up during the COVID era, and the other stocks like oils didn't go up as much, banks didn't go up as much. So it appears, if there is an analogy with history, it would be the dot-com bubble, and what we should expect to happen is that the stock market is going to go down, and the tech stocks will go down a lot more than the so-called value stocks. In conclusion, the stock market is probably in a bubble similar to the dot-com bubble of 2000. A significant U.S. stock market pullback is likely in the future. As a result of that, and correlated with it, some correction in the housing market is likely due to increasing interest rates and the negative wealth effect from a stock market correction, but a large drop in the housing prices in the near future, similar to 2007 to 2009, is unlikely due to a shortage of housing supply. If you would like to read more on these topics, some of the data for this video came from the Calculated Risk blog, some came from Eye on Housing, some came from the National Association of Housing Builders. A lot of the excellent graphs came from longtermtrends.net, and other ones came from tradingeconomics.com. If you enjoyed this video, please hit the big red subscribe button. It will help me grow my channel and make it easier for you to find my other videos. I thank you for watching this video.